Hello, everybody, and welcome. I'm Travis Watts, Director of Investor Relations at Ashcroft Capital. Today, what we're talking about are the different investment strategies that can be used in the multifamily space. More specifically, what we're covering is core plus, value add, opportunistic, and development. So this is the specific strategy that the general partners are trying to accomplish in order to generate revenue for their investors. So I just want to start by defining these simply for you. So a core asset is more often than not what institutional buyers are looking for. It's more of your turnkey property in a well-located area with high occupancy, high collections in place. It may have been a newer property that was recently built and is now filled up, or it may be 10 years old for example purposes. So it's going to be your major city hubs. You're going to pay a higher price per door for having the best amenities and a newer building, high occupancy and collections, and pretty much everything ready to go at the property level. Higher risk, higher reward. Core assets, generally speaking, hold the least amount of risk out of these that we're discussing. The second type is Core Plus. Now, Core Plus is very similar, but it's got a little more risk associated because it might be a little bit older, which means the property does have some maintenance that needs to be addressed, or it may lack some of the amenities, or it may be in a less desirable area. So instead of, for example, being right in the heart of Dallas, Texas, it might be in Richardson, Texas, or Haltom City, Texas, or something like that, a submarket of a major metropolitan area. Still commonly bought by institutional capital. You start seeing more private real estate investors and syndication groups coming into this sector. And then we move to value add. Now, value add is what Ashcroft Capital specializes in. These are often properties built in the 1980s, 1990s, maybe up to the early 2000s. And often they've already been held for many years by either an institutional group or another syndication group. Sometimes individual investors are in the space, not very often. And at the stage that it's being sold, it just needs some updates. Maybe it needs clubhouse updates, unit renovations, landscaping, signage, you name it. It might have a lot of, we'll call them problems, but they're also opportunities to add value, both to the residents who live there and of course to the investors. So Ashcroft Capital will come into one of these properties, whether it was bought off market or whether it was publicly listed. We will rebrand with our own branding. We will renovate the clubhouse units and common areas, and then we will reposition and look to sell several years later. And who are we selling to? Again, often institutional buyers, because what we really just turned this into is more of a core plus asset, more of a turnkey model with high occupancy and high collections, and most, if not all, of the maintenance issues addressed and fixed. Value add properties will still often have pools and gyms and barbecue areas, but they're not going to be state-of-the-art facilities like you might see in a brand new built core asset in a downtown metropolitan. The way I look at value add is kind of your middle of the road standard apartments. Some people, you might hear the term workforce housing, affordable housing, although that's not really the technical term because we're not talking about any kind of government subsidized housing. We're just talking about affordable rents for most Americans. All right, now we move up the scale to opportunistic plays. Now, opportunistic, again, has a little more risk to it. So instead of coming into a property with high occupancy, high collections, but maybe it's a bit outdated, instead, these properties often have a lot of issues with them. So it may have very low occupancy, which tells you that there's often a major problem happening, or it may have some structural or foundation issues, or it may be located in not such a great area. So there are operators who specialize in this kind of sector where they come in and they completely turn a property around, gutting the units, taking them down to the studs, so to speak, and completely trying to turn around, remarket, and revitalize an apartment community. So it takes an awful lot of work, an awful lot of capital to enter deals like these and successfully turn them around. But there are groups who specialize in that business plan. From a cash flow perspective, many of these deals do not offer cash flow because the occupancy and collections are so low, or because you may have to actually remove the current residents from the property in order to execute the business plan, thus making it a riskier investment, generally speaking. And the last business model I want to cover is development. That's pretty self-explanatory. We're talking about newly constructed apartment buildings. These assets mostly do not cash flow for a handful of years as you go through the actual construction and development, and until you can start leasing, renting them out to residents. There's lots of variables and moving parts with supply chain and with permits and with licensing and with municipalities. And of course, with a new development, there wouldn't be a track record to look at for the performance of the property because it's never existed prior to this moment. So again, higher risk, higher reward, generally speaking, not a cash flowing asset. So I hope you found this video to be useful, discussing the different strategies that exist. If you have additional questions regarding Ashcroft Capital or value add investing, feel free to reach out to myself, Travis, at ashcroftcapital.com.